Sam&Cents. Money that finally makes sense. Look at your last payslip. Find the biggest deduction on it. For most people in this country, that line is federal income tax withheld. And here is the strange thing about it. You never touched that money. You almost certainly never decided the amount. Although, and hold on to this, you are allowed to. You never had to hand it over. It left before you ever saw it. Last time I promised you the man behind that line, and here he is. Not a president, not a senator. The treasurer of a department store who in 1943 won an argument that is still running on your payslip this month. And he won it by offering to cancel a year of tax. Now, before any of it, the warning label, because this is a subject people fight about, and I am not going to help them. This episode is not about how much anybody should pay, not once. It is about when the money moves and who does the paperwork. That is a completely different question, and it has a completely different answer. The official record of this law says it plainly. The bill imposed no new taxes and applied only to individuals. So here is the open loop. He asked for a whole year of tax to be cancelled. He did not get a whole year. What he actually got is a formula. And 80 years later, that formula is the reason you get a refund or a bill every April, and the reason a lot of people think the refund is a present. I will give you the formula exactly, and then a 2-minute check on your own payslip that comes straight out of it. To see the problem, you have to see how small this tax used to be. In 1939, about 7.5 million individual income tax returns were filed in a country of more than 130 million people, and the total income tax on all of them came to under $1 billion. And note what I just said, 7.5 million returns, not people. A joint return covers two. This was a tax on the comfortable. If you worked for wages, it mostly had nothing to do with you. And because it was a tax on the comfortable, it was collected the way you would collect from the comfortable. On trust, in arrears, from people assumed to have money set aside. And that is the detail everything turns on. So let me put it plainly. You earned your money in 1 year. You did not pay tax on it in that year. The following March the 15th you filed, and the bill came, for a year that was already over, and you could spread it across 4 equal installments through the year after that. Read that again from the point of view of somebody with savings. It is a gift. You hold your money for an extra 12 months. Now read it from the point of view of somebody living on a wage who has never paid this tax before and has nothing set aside. The bill is for money that is already spent. Then the country went to war and the arithmetic changed completely. Federal spending went from about $9 billion in 1940 to more than $90 billion in 1945. That money had to come from somewhere, and in October 1942, Congress passed a Revenue Act that reached down and brought millions of ordinary wage earners into the income tax for the first time. It also added something called the victory tax on incomes above $624, and importantly that one was taken straight out of wages starting in January 1943, so now hold both halves of that in your head at once. 40-odd million people are about to owe an income tax. The system bills them a year late. Most of them have no savings, and the ones who do have savings are being asked to lend them to the war effort. Everybody in Washington could see what was coming, a bill arriving for a year already gone, to people who could not pay it, all at the same time. And I want to be careful here because this is the point where people reach for the word cheating. That is not what the record shows. It shows an administrative problem, a collection system built for a few million careful filers being pointed at 40 million wage packets, and nobody at all certain the money would physically arrive. The obvious fix was to put everyone on current payment, pay as you earn, out of the pay packet, the same way the victory tax was already being taken. And the obvious fix had a wall in front of it. Here is the wall. If you switch from paying a year behind to paying as you earn, there is 1 year in the middle where both bills land on the same person. The bill for last year, which you still owe, and this year's tax, now coming out of your wages. 2 years of income tax in 12 months. They called it doubling up, and there was no clever accounting around it. The money for the year just gone had already been earned, already been spent, and was already owed. Somebody was going to have to either pay it or be told they did not have to, and those were the only two doors. That was the whole fight, and for the better part of 2 years, Congress could not walk through either one, so the obvious fix sat there, obviously correct, and completely stuck. The man who broke it was not a tax expert. Beardsley Ruml was a psychologist. He took a doctorate at Chicago in 1917, and the next year he was helping design the aptitude tests the army used to sort 1 million men. Then he spent the 20s running a Rockefeller Foundation that paid for social science, for measuring what people actually do rather than what they say they do. He became a dean. And then, in 1934, he did the thing that makes him useful to this story. He took a job as treasurer of R.H. Macy and Company, the department store. He was also, by 1941, chairman of the board of the Federal Reserve Bank of New York, which is a bank directorship, not a seat at the controls of the economy, and I want that clear before anybody builds a theory on it. And here is his move, which is the whole episode. Everybody else in the argument was fighting about rates, how much. Ruml stopped arguing about how much and started arguing about when. His proposal was, put every taxpayer onto current payment, and to get over the wall, cancel the old year's tax outright. Skip it, not reduce it, not defer it, cancel it, so that nobody ever pays 2 years at once, and from then on everybody is simply current. 1 year of tax, he argued, was the price of never having this problem again. Now before the vote, the correction this story owes you, because you will read everywhere that Beardsley Ruml invented tax withholding, and he did not. Withholding is as old as the income tax itself. The very law that started it, the Tariff Act of 1913, collected it at the source. Employers, landlords and banks had to deduct the tax from salaries, wages, interest and rent above $3,000 a year and hand it straight to the government. Dividends were written out of it. Then in 1917, on the Treasury's own recommendation, Congress pulled that back to foreign taxpayers only, and the American earner went back to paying it himself. Money had been coming out of American pay packets for Social Security since 1937, and the victory tax was already being taken from wages 6 months before the law we are talking about was even signed. So he did not invent the deduction. What he did was solve the transition, the one problem that had kept the deduction from ever being applied to everybody. The fight over it was real and it was public. The House Ways and Means Committee turned the plan down, and its report said why. The whole 1942 tax came to about $10 billion, and the committee said the government could not afford to cancel it. The same report added that anyone who had a windfall year in 1942 would escape the tax on it entirely. Ruml's side argued you could not put a country on current payment any other way. The Senate went with Ruml. It passed a bill cancelling the whole year with anti-windfall exceptions written in. Then the two houses went into conference, and the conference cut it down. On the 9th of June 1943, the President signed the Current Tax Payment Act, and here is the formula exactly, because this is the part that gets garbled everywhere. Take your tax for 1942 and your tax for 1943, and look at the lower of the two. If that lower figure was $50 or less, the whole thing was discharged. Otherwise, 75% of it was cancelled. The remaining quarter did not go away. Half of that quarter, 12.5%, was payable on the 15th of March 1944, and the balance on the 15th of March 1945, 75% off the lower of 2 years, and the rest in 2 installments. That is the whole of it, and it is not the same sentence as 1942 was forgiven. On the 1st of July 1943, the deduction started. Employers took 20% of wages above an exemption. 17 points of that was the income tax, 3 points was the victory tax, and the exemption was $12 a week for a single person, $24 for a married one, with more for each dependent. And the effect was not subtle. In 1943, 43.7 million individual returns were filed. By 1945, it was just under 50 million, and the tax owed on those returns came to more than $17 billion. Now, I am not going to tell you that withholding created those taxpayers, because it did not. Look at the year before the law, 1942, 36.6 million returns. The 1942 Act had already reached those people. What withholding changed was not who owed, it was whether the money actually arrived. The machine worked. It has been working ever since, and it has never been switched off. There is one more voice here, and I'm going to give it to you with the other side attached, because it is usually quoted without. A young economist called Milton Friedman worked in the Treasury's Tax Research Division during the war on the design of exactly this. Decades later, in his memoirs, he wrote this about it. It never occurred to me at the time that I was helping to develop machinery that would make possible a government that I would come to criticize severely. That is a real quotation, and it is his own considered view. It is also one participant's opinion, written 50 years afterwards, and it is not a finding. The people he worked with argued the opposite at the time, that with tens of millions of new taxpayers and no savings behind them, deduction at source was the only way the thing could physically be collected. I am not going to referee that. I am going to hand you the machine and show you the one control you have on it. So, the machine is still on your payslip, and it is the same machine. Your employer works out a number from published tables, takes it before you are paid, and sends it in. Annual filing is older than any of this. What 1943 changed is that most people now arrive at April having already paid, so the day is a settlement rather than a payment. And once a year the books are squared, what was taken versus what you actually owed. That difference is your refund or your bill. It is not a reward and it is not a punishment. It is the size of the gap between an estimate and the truth. And here is the part that is genuinely yours. The estimate is one you can change. So, 2 minutes. 1. Find the federal income tax withheld line on your payslip and the year-to-date figure next to it. 2. Compare that year-to-date figure against the total tax line on last year's return, not the refund, the total tax. 3. If the gap is big in either direction, run the withholding estimator on the tax authority's own website and file a new W-4 with your employer. That is one form. And the reason it matters, in the least dramatic way I can put it, and that form is not an afterthought, it is part of the original design, because the 1943 law came with an exemption certificate you filled in yourself, and that certificate is the ancestor of the W-4 sitting in your payroll system right now. If you over-withhold, your refund is the size of an interest-free loan you made. And that is only true of a refund caused by over-withholding, not of a refundable credit, which is a different thing entirely. If you under-withhold, a large enough gap can carry an underpayment charge. Both are fixed by the same form. One boundary, plainly, this has been general financial education, not personalized advice, and every number here is United States federal mechanics that does not transfer to other countries. Beardsley Ruml died in 1960. He is remembered, when he is remembered at all, for something he did not do, inventing a deduction that was already a century old. What he actually did was unstick it and hand 40 million people a habit of not noticing. You have just noticed. Next time, the man who bet a company would fail 400 years ago and the law they wrote to stop him. Same channel. So there it is, small boring moves that quietly win. If your money makes a little more sense now, hit subscribe to Sam&Cents. And the next one's right here, it picks up right where this leaves off. See you there.